All right, hey everyone. Just want to get my lights a little rancher. All right, so well, that's one of my guinea pigs going nuts. You probably hear him. I think that's Walker, Texas rodent. All right, so when last we checked into the market, it's looking pretty vulnerable, and I know we were up today, but here's the spy right off the bat. Now, notice where we closed is lower than yesterday's open. So this was the closing price 2 days ago. This was the opening price yesterday. This is the closing price today. Now I know this is kind of early or soon or whatever you want to call it, but we could be starting to form a downtrend here. And if you look here, I mean, I know we have all the hype and things are great and Santa Claus Rally and blah, blah, blah. We've kind of just been going sideways. We had that big move on that Wednesday. Everyone was all giddy about, and where did we get to? Like 471, and where today? 472. So the market's really been going sideways. And now let's think about the market in terms of equilibrium, because if you are looking at a chart, that's what you should be thinking. What does this tell us about the equilibrium? Well, if a market's going up, it's out of equilibrium. There's not enough supply to fill all the demand. Or there's more demand than there is supply. I guess you can look at it either way, but it's the same thing. So buyers have to pay higher prices. They have to be willing to pay higher prices. Maybe the last trade is at 460, and you're a big institutional trader, and you go in there, and it's like, all right, I want to buy 1 million shares at 460. And someone might say, hey, there's not a lot of buyers around, so I'll pay you 461. Take it or leave it. This is the best price in town. And then maybe it happens again. Someone else comes and wants to sell at 461, and someone says, okay, I'll buy your shares, but I'm the only game in town. I'll pay you 462. So when there's not enough supply, the buyers are forced to increase the prices that they're willing to pay. And that puts us into an uptrend. Now, when we start to go sideways, like we have over the last more than a week now, well, what's today? Thursday? Yeah, so the last week, we've been going sideways. What does sideways mean? Well, this means that the market is in equilibrium. Okay, so we go from out of equilibrium to in equilibrium. Supply and demand are kind of the same, so we're going sideways. Now think about it. If you're going to go from out of equilibrium on one side to out of equilibrium on the other side, at some point when you're making that turn, you're going to get to where the equilibrium is equal. And that could be right where we are now. And these trading ranges in your traditional technical analysis terms could be called a rectangle pattern. And all it is a trading range. And this is how markets are. They don't go in straight lines. So it got ahead of itself. We're kind of going sideways now. Who's going to end up winning this war over the next few days? It's the bulls or the bears. I don't like to have an opinion as a trader, but you probably want to hear my opinion, but trust me, I've been wrong before. I let the market tell me what to do. And so opinion an opinion is a dangerous thing for a trader to have because it could alter your thinking and make you ignore things you shouldn't. Anyway, that's more of a psychological thing. But we're getting close to an all-time high. Now, why is there resistance at all-time highs? Well, it's because of our psychology. People bought back here and finally gets back up to their price. They've been underwater ever since. And they're like, I can finally get out of this at break even. So you get these remorseful buyers selling at a level that was previously resistance. And that, if there's enough of them, it'll create resistance again. So very common in markets to run into resistance at former resistance levels. And it's not voodoo or astrology or tea leaves. When people find out, like I'm a chart person, they're like, that's astrology, blah, blah, blah. And you know what? For most people it is, because they don't really know what the hell they're talking about. And in my opinion, they give us a bad reputation of what we do here. A chart is just an illustration of market psychology and supply and demand. That's it. These patterns are not voodoo. I mean, there's a reason why we find resistance at former resistance levels. See how we were here, and then we got resistance there. So I've been talking about the financials. I think the financials are kind of in the driver's seat right now. Different sectors drive the market at different times, and I think now probably the sector to pay attention to the most is the financial sector, because we might be breaking this resistance. I think we're going to, a lot of what is going to go on over the next few days is going to happen here. So check back. But this is the sector that was the strongest sector on the way up. It's gone into a sideways range. It might be on the verge of breaking this, what was support. Levels that were resistance can also become support. And that's if it goes higher, people that sold at the resistance are like, I made a mistake. I want to buy my shares back. If it gets back to the price that I sold them at. So you get remorseful sellers placing buy orders at the level that was resistance. So if this resistance gives way, there's a good chance the financials get to make a pretty decent move lower, and I think that'll bring the broader market lower. There's pretty extreme sentiment readings out there. Here's the S&P 500 ETF SPY, which we were just looking at. Look at the inflows. And just to make a long story short, what inflows is, a lot of people want to buy these things, right? So many people want to buy them that the market makers just creating new shares and selling them short to the people that want to buy, and that money goes into the fund, and that's the inflow. So this is a record inflow. That shows me people are record bullish. And I am not saying this is going to happen. Oh, big fan of the revolution or history. I'm not saying that this is going to happen, but if there's some kind of catalyst, if interest rates really start to move higher, or if the Middle East starts to go up in smoke over there with all the stuff going on in the Red Sea, and sellers come into the market, it's like the vast majority of buyers, people that wanted to buy, are done buying. So the market could run out of buyers, so the sellers could come in and it's like, hey, where's the buyers? Now it's the opposite of an uptrend. Now the sellers need to offer their shares at lower prices. Okay, the last trade was 99. You got 1 million shares for sale. I'll pay you 98. Next person comes in. All right, well, you know what? The last traded at 98. I'll pay you 97. And we start the snowball effect. So anyway, going forward over the next few days, we still got to focus on here. It's pretty much the same message as it was yesterday. We still got to focus on here. We still got to focus on the financials. We have to understand that the sentiment is extremely bullish, and that is a contrarian signal. Like I said, if the vast majorities of investors are bullish, they spend their money. They run out of ammunition, so to speak. And once they're out, there's no buyers left in the market to push it higher, and the only way it can go is down. All right, so I think those are the main things to focus on over the next few days. I'm Mark. I'm the head of the Benzinga Trading School, and I hope to see you soon.